This content is not directed at persons in the UK and must not be acted on by UK residents. It's educational content, it's not financial advice. Crypto is highly volatile, you could lose everything. Always do your own research. FIGR Markets is the sponsor of today's show. So for the last 5 years, everyone's been arguing the same thing. Institutions are coming. And this has been the narrative. And while everyone was watching memes and arguing which L2 would actually be useful, something actually happened. And right now there's over $26 billion in RWAs sitting on blockchains. And that number was just 6.6 billion 12 months ago. So it's quadrupled in a year. Now I'm not talking about stablecoins, I'm talking about tokenized assets, right? Government bonds, real estate loans, commodities, real stuff, like real institutions coming on chain. The actual adoption wave is here, right? But the biggest number comes from somewhere most people have never even looked or even heard of. It comes from lending. Real loans against real property, processed entirely on chain. And one company has done more of it than anyone else. I had Robbie Young from Animoca on Risk Takers. Definitely check that show out. But he dropped this incredible stat that sort of sent me down a little rabbit hole. $15 billion is on-chain loaned against American houses on a blockchain. So my first reaction was like, this can't be true. That's absolutely crazy. How does this work? How do loans go against real houses? How do those loans end up on chain? But this company, right, FIGR Markets, who are sponsoring today's show, are the guys basically behind these home equity lines of credit that end up on a blockchain. And what they're doing is worth understanding. So let me break it down. So who are FIGR? If you remember in 2025, when crypto companies started going public, Circle, Bullish, eToro, there was a crypto IPO wave. FIGR was part of that wave. They listed on the Nasdaq in September last year. They raised about $788 million, and they were already profitable at that point as a company. $29 million in profit in the first half of 2025. And this isn't some startup running on hopes and VC money. They're actually making real money. And here's the thing that kind of caught me off guard, I guess. Their main business isn't crypto. They're the biggest non-bank home equity lender in the United States. They lend people money against their houses. And they've done over $20 billion of that, all processed on chain since 2018. There are companies whose entire job is to tell Wall Street what's safe to invest in. S&P, Moody's, Fitch, they rate everything from government debt to corporate bonds. They looked at FIGR's loan bundles, these home equity lines of credit, these loans against people's houses, and gave them a AAA rating. It's the highest one that exists. To put that into context, the US government itself doesn't have such a good rating anymore. If you remember last year, the S&P downgraded them. Well, actually, Moody's downgraded them last year. The S&P downgraded them back in 2011. Anyway, FIGR's home equity loan bundles are rated higher than US government debt, which is pretty crazy to think about. So this might tell you something about how traditional finance views these particular loans. Okay, now let me explain what's actually happening here. Americans own roughly $35 trillion in property. A home equity loan lets someone borrow money against their house without selling it. So let's say a house is worth $500,000 and 300 grand's been paid off. The owner can borrow against the 300 grand that's being paid off. It's one of the cheapest ways for normal people to get cash, to get credit. And it's blowing up right now because during 2020 and 2021, Americans locked in a bunch of cheap mortgage rates, 3-5%. And those rates are much, much higher now, 6.5% and climbing. So if they need cash, they need to replace that 3% mortgage with a 6% mortgage. No one's going to do that in their right mind. So instead they can take out separate loans on top of it. And they keep the cheap rate because the original mortgage stays intact, and they only pay the new rate on the new loan. And that's why demand for these particular loans has been the highest it's been in 17 years. Now, this might tell you something about the US economy as well, and I've done plenty of shows showing exactly where I think the US economy is right now and how the consumer is definitely struggling. This is a big portion of that, but I digress. Normally, one of these loans that's issued against the house, these home equity lines of credit, they take like 40 days to process, right? So it can take quite a long time. Paperwork, middlemen, like lots of back and forth. FIGR says they've got this number down to just 5 days because they built the entire thing on their own blockchain. This blockchain is called Provenant. If you've ever looked at RWA.xyz, Provenant is one of the largest blockchains by TVL because they're issuing something that basically no other chain is actually doing. And the loan is created on chain, it's verified on chain, and it's settled on-chain. And here's where the blockchain part actually matters. Every time a company like FIGR wants to package up loans and sell them to investors, everyone has to be audited. And normally that costs about $500 per loan. With blockchain, nobody can tamper with it, so the auditors don't need to check every detail anymore. This means that FIGR's auditing costs have dropped from $1.5 million per deal to about $90,000. And that's not just a small improvement, that's like a 90% cost reduction, because the blockchain does the verifiable part of trust for them. Now, the approach here is the opposite of most RWA projects. Most start in crypto and try to bolt on real world stuff. FIGR started with a massive real lending business and moved that entire thing on chain because it was more efficient. Now, this is the part that is directly relevant to like crypto holders. Say someone wants to hold Bitcoin, ETH, Sol, whatever, right? They think it's going to go higher, but they need cash today. Maybe it's for a down payment on a house, or maybe they just need some liquidity for whatever it is they want. If they sell, they pay tax on the gains and lose their position. Crypto-backed loans let people borrow cash against the crypto without selling it. If you've ever heard of the term buy, borrow, die, which is rich man speak for you don't sell your assets, FIGR allows people to go away and do this. And FIGR's version works like this, right? The borrower puts up their crypto. Sounds terrifying, but don't worry, it's nowhere near as scary as the old days. FIGR lends cash at about 8.9% on a 50% loan to value ratio. So if they deposit 100 grand in Bitcoin, they can borrow about 50 grand against it at like 8.9%. Now, 2-to-1 leverage in crypto, you are going to get wiped out if history is anything to go by. You know, crypto suffers 50% pullbacks all of the time. So 50% pullbacks are likely to be liquidated. Obviously, crypto is incredibly risky, crypto is incredibly volatile. 2-to-1 leverage gets you wiped out in the stock market, let alone in crypto, but you can borrow up to 50% for whatever reason. There's no credit check. And there's no penalty for like paying it off early, like, you know, redemption charges that you sometimes get. Now, the crypto goes into a wallet where the key is split between multiple parties, right? So nobody can move the funds alone, not even FIGR. So for funds to be moved, both parties, the holder and FIGR, need to actively sign that transaction. It's not like it's held by FIGR or it's held by the person. This is actually a breakthrough that, you know, never used to happen with when you deposited funds in like Celsius or BlockFi, for example. Now, and the big fear with any crypto lending platform is, of course, liquidation, as I just mentioned. The price drops, the platform sells the collateral at the worst possible moment. FIGR's system handles this, but with a buffer. So if the price starts dropping, spare cash in the borrower's account can automatically pay down the loan, so the ratio stays safe, or the borrower can actually deposit extra collateral, so they actually get a margin call. You know, wouldn't it be great if a position on Aave got a margin call when someone was about to be liquidated? This actually means that those horrible wicks that you see in crypto that, you know, bounce 20% in one candle, they are not going to wipe people out, because basically the person's got close to 24 hours to basically pay off if they so desire, right? Which makes it a little bit more forgiving, a bit more traditional finance based than just you're liquidated, nothing you can do about it. Okay, and here's where it all kind of connects together. FIGR has these loans on chain, home equity loans and crypto-backed loans. And those loans produce interest, of course. Borrowers are making payments every single month. That interest is a real cash flow, it's a real business, it's a fully functioning business. And FIGR built a product called Democratized Prime. And that lets people earn yield from those loan payments. There are different pools depending on what's backing the loans. Home equity, crypto-backed, stable coins, and the rate is roughly 9%. And this is paid every hour actually, so it's a really consistent yield. And this yield comes from real borrowers making real payments. Homeowners paying their mortgage, right, or paying their home equity line of credit. Crypto holders paying interest. Actual money in, actual money out. Normally, investing in the same kind of loan pools that Goldman Sachs and BlackRock buy into requires being an accredited investor. It requires knowing someone who can get access to a special purpose vehicle. Connections most people have not got. FIGR's claim with Democratized Prime is that it opens up the door to those loans to a wider range of people, and it's all verifiable. You can just look up FIGR and you can see the collateral is all on chain. Those deposits are all on chain, those repayments are all on chain. And that level of on-chain transparency is not something traditional finance typically offers. Again, it shows breakthrough with blockchain tech. And now I know what everyone's thinking: Celsius, BlockFi, Voyager, Gemini Earn. earn yield on your crypto is the exact same pitch that blew up in 2022. So why should this be any different? But there are actually real differences. With Celsius, they took depositors' crypto and they mixed it in with everyone else's. They lent it out, they traded with it, they did basically whatever they wanted. Same with FTX. With FIGR, crypto collateral sits in its own wallet. And again, the key is split, so nobody alone can move it. Nobody alone is in control of it. The person who deposits and FIGR have a split key. FIGR is also a public company, so they have to open their books to regulators every single quarter. And the yield isn't coming from some token they invented. It's coming from homeowners and crypto borrowers paying interest on real loans. Now, of course, as with everything, there's always risks, right? Risks to home equity lines of credit are that if borrowers don't repay their debts, well, FIGR are left holding the bag. Now, FIGR have, of course, actually been really successful in bringing these loans on-chain. They are the biggest lender in this space, and they plan to continue this growth. And of course, this crypto lending portion of their business is an enormous part of their business that they want to expand on. So it is within their best interests to look after their clients. It doesn't remove every piece of risk, obviously. Not your keys, not your crypto is not just a meme. Even signing the wrong transaction risk, there's all kinds of risks associated with crypto. I probably don't need to tell you these risks. Crypto is incredibly risky. Taking leverage on crypto is incredibly risky. Don't forget, borrowing against crypto is inherent leverage. I'm going to get the guy who created FIGR onto Risk Takers at some point in the future. It'll be a super interesting conversation. He's got a bunch of incredible ideas when it comes to tokenization. Check that out when it comes out. Otherwise, thanks ever so much to you for watching. Thank you very much for FIGR for being a part of the show, and I shall see you in the next one.